Good afternoon, everyone. I am CA Megha Saxena, Secretary to Auditing and Assurance Standards Board. On behalf of the board, I welcome you all for today's webinar on Materiality, Understanding the SA 320, along with CA Vivek Nutia. And we also have a pleasure of having our Vice Chairman, CA Ravi Patwaji, who is also here and has come out from a very important meeting today to attend all of you. So I'll request CA Ravi Patwaji, Vice Chairman AASB, to kindly give the opening remarks for the webinar. Welcome you, sir.
Thank you, Meghaji. And I welcome my good friend and a very, very good professional, CA Vivek Notia. And today's discussion is on materiality, which is perhaps one of the most important auditing standards. Some people have started discussing that sampling and materiality would not be relevant. We are not of that school. We do not agree to that. Materiality will still remain relevant. 570 would drive materiality in fact. So whatever, Vivek ji would definitely discuss all the nuances relating to materiality. Uh, and since all of you are interested in hearing from the speaker, I would not take much time. I welcome all of you, and I thank Vivek ji for accepting our invitation and becoming a faculty for the webinar. Thank you very, very much, friends.
Thank you, Ravi.
Thank you, Vice Chairman, sir. Before handing over to the faculty, I would like to give a brief introduction of him. CA Vivek Nutia is a partner of Messrs. S. Jayakishan, a distinguished finance and legal professional with over 2 decades of rich experience. He is a fellow chartered accountant, LLM, certified information system auditor, registered valuer, and a specialist in international taxation, IFRS, and forensic accounting. He has contributed extensively to ICI through various boards and committees, including the ASB, Ind AS, IFRS Advisory Board, and the Expert Advisory Committee. His expertise span valuation, forensic and investigation audit, corporate restructuring, mergers and acquisition, and regulatory compliances. He has also been a sought-after speaker at several prestigious forums, including ICI and the other international forums. We welcome you, sir. Thanks for sparing your valuable time with us and today addressing the participants of the webinar. Thank you.
Thank you, Meghaji. Thank you. I'll share my screen. Thank you, Raviji, for the introduction to the topic. I think materiality is very, very important, and thank you, AASB, for organizing this series of auditing standard discussion. This is much required and order of the day, wherein we professionals are required to understand and implement the auditing standards to the core. I hope my network I'm audible and the screen is visible. I've put it on.
It is visible. It is visible.
So the mandate today is to discuss two specific standards, SA 300 and SA 320. SA 300 would be planning and audit of financial statements, and SA 320 would be discussing on materiality in planning and performing the audit of the financial statements. So when we talk about these discussions on standards of auditing, there has been if you look at the recent past of how these standards, there has been a significant overall improved discussion on the standards of auditing. Is if you look at for the last 10-15 years, there has been an increased awareness towards audit quality. There have been standards which have been introduced in the last 10-15 years on standards of auditing with respect to audit planning, with respect to materiality, with respect to other specific areas wherein standards of auditing require you to have specific programs for specific areas to address the audit risk which you are carrying when you are doing an audit of the financial statements. So what happens is when you look at these standards, what do these standards help you with? Essentially, these standards help you with increasing or there's an incremental improvement in audit quality that you carry out when you do the audit of the financial statements and comply with the standards of auditing. So what when the standards of auditing were not there earlier, it does not mean that those standards of auditing, even when they were not there, the audit quality was deficient. The audit quality was still there. The professionals, the auditors, the chartered accountants who were exercising their professional judgment and carrying out the audit of financial statements carried out with due professional skepticism the requirement of the audit of the financial statements to express a true and fair view on the financial statements as a whole. Coming to today, when we are required to comply with the standards of auditing, NAFRA coming with various mandates on ensuring compliance with QRB Quality Review Board of the Institute of Chartered Accountants of India, requiring us to comply with the standards of auditing. There is a increased requirement to ensure right documentation, proper documentation to ensure that audit is carried out in an effective manner. So, so what happens when you comply with these standards of auditing? The overall quality of the audit improves. And when you ensure documentation with respect to how standards of auditing are complied with, you look at a perceived improvement or an incremental improvement in the quality of the audit that you carry out. So, so, so basically, when you look at how what we will learn in the process of uh, with respect to the standard of auditing on planning, look at the planning on audit of financial statements, the benefits of planning, what is the requirement with respect to involvement of key engagement of key engagement team members, what are the elements which are involved in the process of planning, what are the preliminary engagement activities that are required to be carried out, how do you establish the overall audit strategy, what how the audit plan is developed, and what are the documentation that requirements that are there. So when you look at all the standards of auditing, you cannot look at only one standard of auditing, I think. You have to look at all the standards of auditing together. All the standards of auditing are interlinked and have to be applied together. So starting from SQC1 to SA700 on reporting, I think you have to look at all the standards of auditing together. And when you look at the standards of auditing together, you are able to demonstrate audit better when it comes to quality, when it comes to regulators coming and inspecting your audit file, when it comes to any person asking a question as to whether the audit has been done in an independent and effective manner. So you have to look at these aspects when you look at planning of an audit. So we so basically when you look at an audit plan, I think well-planned audit is half the work done. So if you see that the audit planning is done properly, 50% of the work would be done when you plan the audit properly. So when you look at SA200 overall objectives of the independent auditor to conduct an audit in accordance with the standards of auditing, the audit essentially involves expression of an opinion by the auditor whether the financial statements are prepared in all material respects in accordance with the applicable financial reporting framework. So with this duty cast on the auditor, we have to ensure that the audit needs to be carried out in accordance with the applicable financial reporting framework. And to ensure this compliance, the requirement is to ensure a proper plan in place before we start or commence the field work which is required or expected in the audit of financial statements. So essentially, the SA 300 outlines the auditor's responsibility of what an audit plan is, what an audit strategy is, how do you prepare that audit strategy, how do you prepare that audit plan when you do the financial statements, and the objective is to plan the audit in a way which enables it to be performed in an effective manner. So planning serves a very significant step in carrying out the audit. We should essentially we should as in recurring assignments, for example, we should start the audit planning activity as soon as the previous year audit is completed, and it carries on till the conclusion of the audit for that year. So the planning is iterative, planning is continuous. Planning has to commence well in time to ensure that you are able to carry out the audit in a timely manner. So this planning helps you to ensure that you comply with the professional standards. It also helps you to carry out the engagement effectively. So what are the benefits of planning? So basically, if you look at how this audit planning helps you in carrying out the audit, is basically it helps the auditor to devote appropriate attention to important areas or the significant or the material areas of the audit. So planning would help you to identify where the risks lie in the financial statements, how you would address those risks when you are carrying out doing the audit of the financial statements. It helps the auditor to identify and resolve potential problems on a timely basis. You can apprehend where the problems could lie. If you are able to plan well, you are able to engage with your engagement team better on a timely manner to ensure that those problems are identified and the experience that a senior professional or the engagement lead partner has in the audit is percolated to the team to ensure an effective audit is done. It helps the auditor to organize and manage the audit engagement so that it is performed in an effective and efficient manner. You're basically able to train your people. It helps assist in a selection of the engagement team members with appropriate levels of capabilities and competence to respond to the anticipated risks and the proper assignment of work to them. For example, there could be an audit which is of an IT company which relies heavily on IT-based controls, information technology-based controls. So you need to have the right IT expert in your team to ensure those IT level controls are appropriately identified and addressed. This planning also helps in direction, supervision, and review of the engagement team members during the course of the assignment. So it helps you to ensure that right directions are given to the team members, right supervision is there, and an effective review is there when the work is carried out. It, it helps you to identify which experts will be required. For example, there could be a valuation expert which is required for the purpose of ascertaining whether the valuation of the financial instruments in the balance sheet is true and fair. You may need to engage an IT-based expert to carry an IT control testing. You may engage an actuary for the purpose of verification of actuarial liability which is there on the balance sheet with respect to provisions for employee benefits, of a provision for warranties, of a provision for contingent liabilities, if at all that is required. You may hire a legal expert, tax expert, if you feel that that is required for the purpose of evaluating whether the tax positions which have been taken by the company are correct or not. So the essential objective is to ensure that audit risk is reduced to an acceptable low level. So a planning of an audit ensures that this audit risk which is there is reduced to an acceptable low level. So when we are drafting an audit plan or an audit strategy, are we required to engage or involve key engagement team members? Yes, that is a mandate which is there as per the standard of auditing. So you need to ensure that not only the engagement partner, but other key members of the engagement team are also involved while planning the audit so that there's an effective discussion amongst the engagement team members of what the key risk areas are, how the risks need to be addressed by performing by the right audit procedures, what has been the experience of the engagement team in the previous year, how the working papers which were there in the previous year, what are the issues which have been identified in the previous year working papers, how those issues are being carried forward. This involvement of the key team members ensures that the experience and insight of the senior professional or the lead partner or the engagement lead is percolated down to the team members and also enhances the effectiveness and the efficiency of the audit process. So coming to what are the elements of planning? So when we look at elements of planning, there are essentially two elements of essentially the elements. The planning is required to be performed at two stages. One is you are required to carry out preliminary engagement activities, and the second is planning activities, which is establishing the overall audit strategy and developing an audit plan. We'll look at how the preliminary engagement activities are carried out. So, so what are the preliminary engagement activities that are required to be carried out when you perform or when you plan for an audit? So what is required is as per SA 220, which is quality control for an audit of financial statements. We need to ensure that we perform procedures regarding the continuations of client relationships and audit engagement. Now, what does this involve? We need to ensure that we involve we obtain information regarding the integrity of the principal owners, key management, and those TCWG or those charged with governance. So we evaluate the whether the integrity of the owners and the KMPs and TCWG continue to be strong. They have the their responsibilities towards preparation of the financial statements. There's no fraud risk. We need to ensure that this integrity is checked as to whether there is a potential possibility of whether they if their integrity is questionable. We need to question the management's intent to prepare the financial statements could affect the true and fair view of the entity. And of course, the fraud risk becomes very important. Whether the engagement team which is there is competent to perform the audit engagement and has the necessary capabilities, including time and resources, for carrying out the engagement. So, for example, let's say the company is required to follow US GAAP framework for its reporting purposes because it's a subsidiary of a US entity. We need to ensure that our engagement team is competent to understand the requirements of the US GAAP and has the necessary capabilities to carry out that audit. If our engagement team is not competent to carry out an audit in accordance with the requirements of the US GAAP, we may be required to refuse the audit because our engagement team is not competent under the circumstances to carry out the audit for the purposes of US GAAP reporting. Whether the firm and the engagement team can comply with the relevant ethical requirements, this is critical. We'll discuss about the ethical requirements, including independence, in the next bullet. Significant matters that have arisen in the previous audit engagement and their implications on continuing the relationship if it's a continuing engagement. So, if, for example, there have been significant matters such as a qualified audit report in the last year, we have to evaluate whether the qualification has continued. What are the steps which have been taken by the management to ensure that those qualifications have been addressed, and whether the intent of the management is there to address the qualifications which have been put in by the auditors in the previous year. So we basis these parameters, we will evaluate whether the client relationship can be continued with respect to the audit engagement that we are engaged in. So these factors should be considered for the purpose of evaluating a continuance of the client relationship, even in the case of recurring event. The second point, when it comes to uh, the procedures which we are required to perform with respect to compliance with ethical requirements, including independence, what we need to ensure that that we comply with the requirements which are laid down in Code of Ethics issued by the Institute of Chartered Accountants. We comply with all the ethical requirements which are there. We need to ensure that independence is also there. So I think independence, when you look at independence standard on as defined in the standard of auditing, it has to be independence just not on legally, but independence has to be state from a state of mind. It has to be you should not just appear to be independent, you should also be independent in when carrying out the responsibilities. So as per the fundamental principles which have been laid down by the institute in the code of ethics when it comes to complying with the ethical requirements is ensuring right integrity is there. We need to be objective so that there's no compromise for in exercising professional judgments. We have to exercise professional competence and due care. Ensure respect the confidentiality of the information which is obtained as a result of the client relationships. Ensure professional behavior is there so that we are acting in accordance with the relevant laws and regulations. So when we look at the compliance with ethical requirements, I think one threat that we should, as a medium-sized firm, specifically address is with respect to familiarity threats. When it comes to familiarity threat, I think this is one area where most of the mid-sized firms have a lot of challenge, and how we address that is something which needs to be looked at when we are ensuring compliance with the ethical requirements. So familiarity threat is something which is when the auditor to becomes associated with the audited entity for a very long period of time, such that I'm becoming sympathetic to the interest of the client concerned. So in which case, there's a risk that there's a familiarity threat. To ensure that the familiarity threat is not there, we need to ensure that the right rotation is there amongst the partners of the firm. A review is a proper EQCR is there to ensure that the the work done for a particular client is reviewed by another partner in the same firm. So those familiarity threats should be avoided when it comes to medium-sized firms wherein the client has been there as an audit client for several years. So when we look at again in complying with independence requirements, we need to also look at all the financial relationships, not even of our firm, but the financial interests of other firms in the same network if there is a network. This is often missed out when there's a network of firms. So as per the institute's guidelines, we need to ensure that independence criteria is met not just by the firm which is doing the audit, but all the firms in the same network to which the firm is part of. So this checking of independence need to be ensured before you continue with the engagement or accept the engagement, even if when it's a new engagement. There could be a possibility that the firm which you are auditing is there's a merger of another company with the company with which you are auditing, in which and you are not independent of the amalgamating company. That could be a potential risk of independence, and if that is the case, you need to be very cautious of how you are meeting the independence requirements in case of a merger of another company with the company with the company which you are auditing. The third is establishing undertaking understanding of the terms of engagement as required by SA 210. So there should be an explicit agreement which you enter into with the management with respect to the scope and terms of the engagement, including the applicable financial reporting framework which is used for the preparation of financial statements. So this essentially refers to the engagement letter, which should be signed, which should be and the terms of which should be accepted by the auditing client to ensure that the uh, terms of the engagement are discussed, are noted, and contractually signed. So, so SA 210 refers to the engagement letter, and this engagement letter should be ensured that this engagement letter is appropriately acknowledged by the audit client to before we continue with the engagement. Additional considerations which are required in case of initial audit engagements, for example, if you are this is these activities are with respect to current audit engagements. With respect to initial audit engagements, when you are taking on or onboarding a new client, there are certain additional procedures which you are required to perform with respect to initial audit engagements. What are those additional procedures which are required? Those procedures would include for regard acceptance of the client relationship with respect to the with respect to the new client which you are onboarding. So if there is a possible risk of we should evaluate as an auditor, we should evaluate the effect of any previous qualification which has been there with respect to that audit client as to how will it affect the risk of material misstatement that you will assess in the current year. So you need to look at the previous audit report, read through the audit report. What are the issues that have been flagged by the previous auditor to assess whether you should onboard the new client or not? You have to have discussions with the management and the key manager personnel to understand all the major issues which have been identified with respect to the uh, audits in the previous years. You have to carry out a review of the opening balances because the audit for the previous year has been carried out by another auditor. So additional requirement of review of opening balances is also required to be undertaken with respect to an initial audit engagement. Procedures which may be required by the firm system of quality control is another area where we should evaluate whether the new audit client meets the requirements of the quality control systems that you have internally within the firm. So these are the activities which you carried out with respect to an initial audit engagement that is carried of a new client which is carried with of a new client which is onboarded by your firm. So these preliminary engagement activities, how does it help us? It helps us to plan and audit engagements to ensure that the auditor maintains necessary independence and ability to perform the engagement. There are no issues with the management integrity that may affect auditors' willingness to continue the engagement. And there is no misunderstanding with the client as to the terms of the engagement. So these are three areas which you should which are covered within the purview of preliminary engagement activities and what benefit is there on carrying out these preliminary engagement activities. Now, planning activity involves two stages. One is establishing the overall audit strategy, and second is developing an audit plan. Overall audit strategy sets the scope, timing, and direction of the audit and guides the development of a more detailed audit plan. Now, there's always a question on what is the difference between audit strategy and audit plan. So, very simply put, I think strategy is the first action when you start with the audit planning. A strategy essentially captures the what and why elements of the desired outcome of the audit of the financial statements. So, what you have to do and why you have to do. It's a very high level blueprint which achieves the goal of an effective audit, but it does not specify how to do it. Whereas an audit plan essentially addresses who will do it, how will it be done, when will it be done, where will it be done. So essentially, the steps, the plan is a more granular or a detailing of the audit strategy. A plan would be more flexible compared to an audit strategy, and plan would change as and when you obtain further audit of evidence in the course of the audit. An audit strategy would be a more of a high level blueprint and essentially only define of what and why elements of the audit, essentially what has to be done and why it needs to be done. Wherein an audit plan would address questions as who will be the engagement team, what were the audit, how are the audit procedures, how will the audit be done, what are the audit procedures required to be conducted, when will the audit be conducted, from what time to what time, and where will it be done, which are the locations that would be covered. If certain locations have been covered in the previous year on a rotational basis, we may cover only some locations in the current year and some locations in the next year. So these would essentially be covered or be would differentiate between what an audit strategy is and what an audit plan is. So coming to establishing the overall strategy, what are the requirements, what are the steps which are involved in creating that audit strategy document? The first step is identifying the characteristics of the engagement that defines its scope. So the characteristics of the engagement would include the financial reporting framework with on which we are required to report on. We have to understand whether we require to perform any reconciliations to another financial reporting framework. For example, we may require to prepare financial statements under Ind AS, but being let's say if that company is a wholly owned subsidiary of a US entity, we may also require to prepare some reconciliations with the US GAAP reporting. There could be a reporting requirement because the holding company is following Ind AS, whereas the subsidiary, which is following another or associate is following another financial reporting framework. In which case, we require to perform reconciliations between the Indian GAAP framework and the Ind AS framework for the purpose of consolidation in the financial statements of the holding company concerned. The need for statutory audit is the statutory audit, whether it's required only at the standalone level or at the consolidated level, whether we are required to address the component auditors also. What is the expected audit coverage? Which are the components of these or which are the branches or the locations we are required to visit? Whether interim work has been performed. For example, if it's a listed entity, we may have already performed certain limited review of the previous quarters. How will the work that we have done in the limited review for the previous 3 quarters affect the financial reporting or the audit of the financial statements for the year as a whole? How can we use the audit procedures that we have conducted or the review procedures that we have conducted during the previous 3 quarters help us in furthering the audit process during the year end? There could be industry specific requirement. For example, in a bank, there's a requirement to comply with the Banking Regulation Act. In case of an NBFC, there are specific directions which are applicable to NBFCs. There could be some industry specific requirements in power companies, power distribution or power transmission companies in which we have to comply with. Those aspects also need to be factored in when you are identifying the characteristics of the engagement. The reporting currency, whether the internal audit is applicable to the entity, what is the IT software that is being used for the purpose of for the purpose of financial accounting, the entity, whether it uses any service organizations for the purpose of processing its data. These are factors which should be considered for the purpose of identifying the characteristics of the engagement to help in developing the overall audit strategy for the purpose of carrying out the audit. Second is ascertain the reporting objectives of the engagement to plan the timing of the audit and the nature of the communications required. What is the entity's timetable for reporting? What is the due date which is applicable to the entity concerned? For example, if it's a listed entity, the due date would be 30th May for an audit of the financial statements. We need to have meetings with the management and those charged with governance to discuss the nature, timing, and extent of the audit work. As per the requirement of the standard of auditing, we need to address and communicate with the management and PCWG to discuss how the audit would be carried out, when the audit would be carried out, what is the materiality level that you will look at when you are doing the audit of the financial statements. And there should be a regular communication with TCWG, those charged with governance. I think uh, one area where National Financial Reporting Authority and QRB has come out heavily on audit forms is we have not discussed enough with those charged with governance. This is again something which we should look at and and ensure that as an audit partner, as the lead partner of the audit engagement, we need to ensure that we communicate with those charged with governance to ensure that we discuss the nature, timing, and extent of the audit work. If the TCWG or the audit committee or this management expects us to look at certain specific areas during the audit of the financial statements, or there are certain risks which are perceived as higher by TCWG, we should look at addressing those risks when we are developing the overall strategy. We need to have discussion with the management with respect to the communication, with respect to the expected outcome of the audit work throughout the engagement. We need to communicate with auditors of the components and communicate with them the expectation of the work which is to be performed by them, what and the reporting requirement expected from them. Any communication from other third parties such as Reserve Bank of India, for example, if it's a NBFC or a bank, is also required to be looked at when you are establishing the reporting objectives of the engagement. There are certain additional reporting responsibilities which are put when it comes to audit of an NBFC, for example, or audit of a bank. We need to write to Reserve Bank of India. We need to have prepare certain certificates. We have to certify on certain specific areas, and we need to put that to the auditor, put that to the regulator concerned. We have to prepare a long form audit report in case of a bank, for example. So these are reporting objectives that we need to understand when we are developing the overall audit. Consider the factors that in the auditor's professional judgment are significant in directing the engagement team's efforts. The significant factors, for example, would involve determination of materiality and materiality for components, for example, if there are branches or subsidiaries which are audited by other auditors. The, the areas where we feel that higher professional skepticism should be there by the engagement team when carrying out or gathering audit evidence during the course of the audit. What is the volume, nature of transactions? Which are the areas where automated controls are there? What is the firm's evaluation of management's commitment to the maintenance of effective internal control? Any significant business development which has affected the entity during the year, for example, there could be a merger, there could be a business acquisition, any changes in the financial reporting framework, for example, the company has moved from Indian GAAP to India's during the period. Those factors should be considered while to understand which are the significant areas where the engagement team's efforts should be directed to. We need to consider the results of preliminary engagement activities and the knowledge gained on other engagements performed by the engagement partner is also required. For example, how are other companies in power sector behaving if the company is engaged in the distribution of power? How are other NBFCs in the same industry behaving if you are doing an audit of an NBFC or, for example, even a bank? So you have to look at those results of not only the preliminary engagement activities, but the knowledge which you have gained on other engagements which you have performed as the partner uh, of other engagements performed by the engagement partner of the relevant industry. The last point when it comes to establishing an overall audit strategy is ascertaining the nature, timing, and extent of the resources necessary to perform the engagement. What are the qualifications of the engagement team that would be required? How many chart accountants would be required? How many article assistants would be required? Whether there's a requirement to the requirement to engage a EQCR for the purpose of reviewing the audit done by the engagement partner. Those are aspects which you look at when you establish the overall audit strategy. Now coming to development audit of an audit plan. Now once we have put in these principles for development of an overall audit strategy, now we look at preparing a detailed audit plan. Now, when you are preparing an audit plan, what are the components of such an audit plan? So essentially, the audit plan shall include a description of three bullets which are specified. First is nature, timing, and extent of planned risk assessment procedures as determined under SA 350. So, for the purpose of understanding what the nature, timing, and extent of the risk assessment procedures that are required under SA 350, you would essentially be required to again inquire of management and those charged with governance. You would carry out analytical procedures to identify whether there have been unusual transactions or extraordinary items in the year. There could be a possible, so you look at a preliminary and you do a preliminary analytical review to understand how what has moved how. So if there has been a significant variance, for example, of other expenses or finance cost, or maybe even the balance sheet line items, you would have to look at identifying that this could be a potential area where the risk assessed is high, and therefore you would have to carry out additional procedures with respect to those specific areas. You look at you observe and inspect the entity's operations, the MIS reports, and essentially come out with a detailed description of the audit plan or the risk assessment procedures that you would carry out with respect to the significant areas that are relevant. So once you carry out these risk assessment procedures, you essentially what how does this help you essentially? You get an understanding of the relevant industry, legal, and regulatory framework, as well as the applicable financial reporting framework that you established as part of your overall audit strategy. The nature of entity, the operations, the locations which are there, how does the ownership and the governance structure looks like, how the entities propose to finance its acquisitions or finance its expansion plans, what are the future capex plans of the entity concerned, how does the internal control look like, whether the internal control is effective, whether the management is keen to establish a, a strong framework of internal control, whether the risks relate pervasively to the financial statements as a whole and affect many line items. You identify the risk with what could go wrong at the assertion level. So you essentially try to identify what could go wrong at the higher, at the significant areas that you have identified, and you try to do that with the understanding of the relevant control which the auditor needs to test when you are doing it. Consider the likelihood of misstatement, whether the potential misstatement could result in a material misstatement. So when you identify what can go wrong in significant areas, you try to identify whether those specific areas has a risk of material misstatement if there is an error or a fraud found in those specific areas. The second is you need to now identify the nature, timing, and extent of planned further audit procedures at the assertion level as determined under SA 330. So once you have identified the nature, timing, and extent of planned risk assessment procedures or at an overall level, that next is you need to identify the nature, timing, and extent of planned further audit procedures at the assertion level as determined under SA 330. So so what, for example, if you are doing an audit of inventory balance, tests of controls oblique substantive analytical procedures may be suitable to validate the completeness assertion. Tests of details may be necessary to validate the ownership and the accuracy, and observation may be appropriate for existence. So for inventories verification, you need to ensure that test of control is carried out to ensure completeness. Test of detail is carried out to ensure ownership and accuracy of the inventory which is carried on the balance sheet. And observation is necessary for ensuring that existence assertion is complied with. For example, in relation to audit of trade receivables, inspection of invoices and bank receipts may be supplemented by external confirmation process to ensure the existence is verified. So you have to ensure that not just that tests of controls, but substantive procedures are also carried out. And those audit procedures which you are required to carry out are mapped to the assertion level. So assertion could be existence, occurrence, completeness, uh, exist the cutoffs. So these are the assertions which you validate when it comes to identifying the audit procedures with the assertion level as required under SA 330. So the first bullet which is there, you essentially you have to identify what can go wrong. For example, capital work progress is a significant line item in the financial statements of the audit client. Now, in capital work in progress, what could go wrong is, for example, incorrect capitalization could be an error. Incorrect the revenue expenditure being wrongly tagged as a CWIP could be an error. Could be a possible area where it could go wrong. Finance costs being capitalized may not be the right, may not be appropriate. That could go wrong. So these are the essentially what could go wrong at the overall level. But when it comes to the second stage, which is SA 330, you determine what are the further audit procedures at the assertion level. For example, you have to look at SA 330 from a, for example, CWIP, whether it actually exists, whether there's a requirement to impair, whether the measurement is correct or not, whether the classification is correct or not. So these are assertions which you need to evaluate at the for the particular line item, and what are the additional audit procedures that you would carry out at the assertion level under SA 330 for the purpose of developing the audit plan. Now, there could be a third point is with respect to the audit plan is other planned audit procedures required to be carried out so such that the engagement complies with all the other standards of auditing which are there in the which are there. For example, so you will look at all the other standards of auditing. Standards of auditing could be on audit evidence, the documentation, the related party disclosures. Those are what are the other audit procedures that would be required to ensure that the audit engagement that you are carrying out is compliant with all the other standards of auditing? What is the audit plan that you will develop to ensure that these audit procedure is essentially complied with the standards of auditing which are there? Now, this audit plan that you develop on a detailed, on a granular way, after establishment of an overall audit strategy, this will help you to ensure that this audit fieldwork which is carried out is in accordance with the audit plan. And when we carry out the actual audit fieldwork, there's a responsibility cast as per the standard to update and change the overall audit strategy and the audit plan as necessary during the course of the audit. For example, you found that whatever controls that you've assessed when you did the initial audit planning is not as per the expectations. So initial audit plan revealed that the controls were quite strong, but subsequently when you actually carried out the audit, you found that the internal control was deficient in multiple areas, in which case you need to change your audit plan and identify the higher additional risks that you have identified as a result of the audit fieldwork that you have carried out. So this, therefore, there's a requirement to ensure that we update and change the overall strategy and the audit plan as necessary during the course of the audit and map the audit plan procedures or procedures which have been identified in the audit plan with the procedures that we're performing as part of the fieldwork. So we need to ensure that this audit plan, which is developed, helps us in determining the nature, timing, and extent of the direction and supervision of the engagement team members and review of the work. So, so this helps us to ensure that the audit plan helps us the helps the engagement partner to ensure that the right direction and supervision of the engagement team members is there and also the review is done properly. Now, coming to so if you look at we discussed about audit strategy, we discussed about the audit plan which is there. So this audit strategy essentially, as we discussed, was identifying an overall audit strategy of what is to be done and essentially the audit plan is detailing on what are the detailed audit procedures that will be required to be conducted in each of the significant risk areas that we have identified as part of the overall audit strategy. So this helps us to ensure that the right audit plan basis and the audit strategy is developed. And this linkage between audit strategy and audit plan is very critical to ensure that it's a speaking document. It's whatever you think is written as part of the audit strategy and audit plan. Think of it as a step which is critical to ensure that the engagement team whom you deploy understand the expectations of the audit, understand the business of the entity concerned, understand the industry of the business of the auditee client. This helps the the audit to be conducted with a better audit quality than what was conducted earlier. What we see is in the mid-sized firm, we generally send the articled assistants and the juniors and the chartered accountant and the audit managers to do an audit without explaining to them the expectations with respect to the audit that is required to be carried out. If we have this documented, if we start documenting this as part of any private limited or any listed company's audit, listed company in any case, the expectation is the bar set is very high. Even in smaller entities, less complex entities, if we start developing this as a document, this helps to ensure that the learning is percolated from one year to another year to the next year when the audit is carried out, and it really serves as a very beautiful document when you start developing this overall audit strategy, the audit plan, to ensure that this to ensure that your team members are essentially aware of what is expected from them. So I think this was with respect to the standard of auditing on audit planning. I will now come to planning and performing materiality. My screen is visible, Vivekji?
No, sir, right now it is not. It is freeze on last screen.
Okay. Visible now?
Yes, no.
So once we have discussed the standard of auditing on, just 1 second. I think this standard on auditing on 320 is a very critical standard of auditing 320 on materiality in planning and performing an audit. This exercise of determining materiality when you're planning and performing an audit needs to be carried out for all audits, irrespective whether it's a private limited company, listed entity. This helps us to avoid doing an over audit when we carry out an audit of an entity. This helps us to identify and do an audit in a systematic manner, in a manner which is expected from the regulators, in a manner which is expected from the standards of auditing, and helps us to also also protect ourselves when regulators ask us a question as to whether you have been able to do an audit properly. So if you look at an audit report which has been signed by you in any of the previous years, if you look at the auditor's responsibility paragraph, what does it say? It says that you have to evaluate whether the auditor, whether you have whether you have or identified any material misstatement in the course of the audit. So if this process of identifying materiality and to ensure that those financial statements on which you are giving a report is free of material misstatement is a critical step in the audit process. If we have not been able to identify the materiality level when we are doing the audit of a financial statements, we are unable to say how the audit that we have conducted is free of material misstatement. So there are two places where you have to specify materiality in the audit report. One is this in the auditor's responsibility in the first para, where you have to specify, please state that the audit is free of material misstatement, and the second is in the as part of the standard of auditing where you have to carry out various steps. One of these steps is identification of risk of material misstatement. So the identification of materiality is the first step to how you can identify the risk of material misstatement when you are doing the activities as stipulated in standard of audit 315 and 330, wherein you identify the risk of material misstatement which is there in the course of carrying out the audit of a financial statements. So the step of computing materiality is a very, very critical step, and there's a very beautiful tool which is available by Standard Center of Audit Quality, which helps us to identify the maturity level in planning and performing an audit. So please ensure that this materiality is determined and computed for any audit that you carry out. This helps in giving a direction to the audit team to ensure that they can identify which items are clearly trivial or non-significant when it comes to an audit of financial statements. Sometimes we spend significant time as an audit team in even items of, let's say, 5,000, 10,000 rupees, although which are clearly trivial items in the context of the financial state audit of the financial statements that we are doing, and we ignore items which are quite material. So this step of identifying materiality when you are planning and performing an audit is probably the most important step when it comes to an audit, statutory audit of a financial statements. Once you adopt this standard of auditing on 320, it helps you to identify that yes, these are areas where you have to put more focus on, and these are areas where you do not need to put focus on or put very less focus. So the step of identifying materiality therefore becomes a very crucial step. So coming to the concept of this one. So in this standard of auditing, what we'll discuss is what is the scope of this standard of auditing, what is performance materiality, what is materiality in the context of an audit, what is the objective of the auditor, how do you determine materiality and performance materiality in planning, what are the benchmarks that are used in determining materiality at the financial statements levels, how do you determine materiality for classes of transactions, account balances, and disclosures, and how do you revise as the audit progress, and what is the documentation that is expected as part of the standard of auditing when it comes to materiality. So essentially, there are two standards which deal with the concept of materiality. One is this standard of auditing, which is standard of auditing of 320, which deals with how the auditor applies the concept of materiality in planning and performing audit of the financial statements. Standard of auditing on 450 discusses application of materiality, and it evaluates the effect of identified misstatements on audit and uncorrected misstatements on financial statements. So the impact of materiality on identifying, or how is the effect of misstatements which have been identified during the course of audit and uncorrected misstatements are aggregated or are having an impact on the audit report that you would be issuing is discussed as part of standard of auditing 450, which will be possibly taken as part of another session. So the objective of this session would be to apply the concept of materiality in planning and performing the audit of financial statements. So we'll discuss mostly on how do we apply this concept in planning and performing the audit of the financial statements. So there are various financial reporting frameworks which discuss the concept of materiality in the preparation and presentation of financial statements. So financial reporting frameworks, for example, if you look at refers to the accounting standards issued by ICI, which talks about qualitative characteristics of financial statements. The para 30 therein specifically talks about the relevance of information which gets affected by materiality. Information is material if its misstatement could influence the economic decisions of users taken on the basis of financial information. So essentially, misstatements, whether it's omission or an erroneous statement, could influence the economic decision of users. It won't, so the word here that is relevant is influencing the economic decision of users. So misstatements are material if in aggregate or individually, they may influence the economic decision of users, not any other decision. So it is not any decision which is an emotional decision which is taken by a user. It is only an economic decision of a user which gets affected as a result of a misstatement, but as a result of a material misstatement in the financial statements. So materiality is a relative term. Materiality is determined, or we judge materiality based on the surrounding circumstances. and affects not only by size or the magnitude, but also affects by the nature of the misstatement. So, for example, if there's a legal requirement to disclose a particular figure in the financial statements, that figure, although small, could be a material figure from the perspective of the this economic decision making of the users of the financial statements, because that is a requirement under the statute to disclose that figure. Now, judgments on matters material to users is based on common financial information needs of our users as a group. So, materiality is not determined based on the individual needs of a user. So, it depends on the common financial. It needs to be determined based on needs of a users as a group, not for a specific stakeholder or for a particular shareholder. It needs to be relevant. The judgment on materials, judgment of identifying material items is dependent on how you look at the information, financial information needs from a group, from a user group perspective, from the stakeholders group perspective, how it would affect their economic decisions. So when you look at accounting frameworks which are there, for example, we discussed about preface to the accounting standard, which talks about materiality. Even when we look at accounting standard 1, which talks about disclosure of accounting policies, it says financial statements should disclose all material items. That is, items the knowledge of which might influence the decision of the users of the financial statements. Even in IAS 1, presentation of financial statements requires that each material class or similar items must be presented separately in the financial statements. Dissimilar items be aggregated if they are clearly immaterial. Even in IAS 34, interim financial reporting requires materiality should be assessed with respect to the interim financial data. So therefore, there is a requirement as per the accounting framework, which is relevant for the preparation of financial statements by the management, that materiality is appropriately assessed when the financial statements are prepared. So therefore, the concept of materiality is also there in the preparation or in the preparation and presentation of financial statements. Now, materiality in the context of an audit. So as an auditor, we also need to determine materiality, which is, as per the standard, a matter of professional judgment and is affected by how we as auditors perceive the information needs of the users of financial statements. So this determination of materiality, which is required to be made as per the standard of auditing, is specifically stated as a matter of professional judgment, and how our perception of is of the information needs of users of financial statements. So if we feel that there are certain information requirements which are critical to the users of financial statements, which in our judgment is critical, we need to ensure that those factors are considered while determining our judgment with respect to the level of materiality that is computed for the purpose of audit of financial statements. Now, when we determine materiality, we need to have some assumptions which is there as per the standard. Now, what are those assumptions? We need to ensure, we have to assume that users have reasonable knowledge of the business and economic activities and accounting, and they have a willingness to study the financial statements with reasonable diligence. Now, materiality cannot be determined based on assuming that users do not have any awareness or knowledge about the business of the entity concerned, or the economic activities which the company is doing, or they are not aware of what are the accounting requirements are. So we need to ensure that we have to assume that users have reasonable knowledge of the business, the economic activities, the accounting, and they have a willingness to study the financial statements with reasonable diligence when we are determining the materiality level. We need to assume that users understand that financial statements are prepared, presented, and audited to levels of materiality. So we need to communicate this very well in the audit report as part of the Standards of Auditing 700 series, wherein we communicate that financial statements have been audited based on materiality thresholds which we have found appropriate considering our judgment. Users need to understand that there are inherent limitations in accounting estimates, judgments, and there could be certain future events which cannot be anticipated. There could be some events which is just beyond the auditor's ability to predict. So those inherent limitations should be recognized by the auditors, by the users. when looking at the financial statements and the audit. Make Again, the last point is users need to make reasonable economic decisions based on information in the financial statements, not specific economic decisions. So auditors should assume that the users make reasonable economic decisions based on information in the financial statements. So, for example, if I am a travel agent, I'm interested in seeing the traveling and conveyance expenses of a particular entity. That's a specific requirement of a particular user when he's reviewing the financial statements, and that may not be addressed when we look at the standard of auditing and materiality when we are doing an audit of the financial statements. We need to look at information needs of the users as a group. We need to look at reasonable economic decisions which the user would be making based on the information in financial statements. For example, whether a user would invest in the company, would engage in a financing activity with the entity, are reasonable economic decisions which a user would make based on information in the financial statements. The specific economic decision for in, is cannot be satisfied based on these general purpose audit that is carried out as based on the audit of general purpose financial statements carried out by the auditor. Now, to discuss on what is performance materiality, actually, so we'll discuss the concept of performance materiality a bit later. We'll just discuss what is an overall materiality and then come to performance materiality. So what is the what is relevant is you determine as part of SA 315, SA 330, you assess the risk of material misstatement and determine the nature, timing, and extent of the procedures that would be required, basis your identification of the risk of material misstatement. Now, you determine the two materiality levels which you determine. One is overall materiality level, and second is performance materiality level. Now, when you determine overall materiality, is to ensure that an overall materiality level is determined, and the second is you determine a performance materiality. What is performance materiality is you determine a performance materiality as an amount which is less than the materiality for the financial statements as a whole, and the objective to identify the performance materiality is to reduce the audit risk at an appropriate level, low level, such that the probability that aggregate of uncorrected and undetected misstatements do not exceed materiality for the financial statements as a whole. So basically, the objective of identifying a performance materiality at an amount which is lesser than the overall materiality level is to ensure that you reduce the audit risk at an appropriate low level, such that if there is a probability of uncorrected and undetected misstatements which could be there in the financial statements, they do not exceed the materiality for the financial statements as a whole, and therefore you are able to have more reasonable you are able to have a reasonable assurance on the financial statements as a whole. So, for example, if the overall materiality, let's say, is set at 100 rupees, you determine a performance materiality at 70 rupees. So, for a particular account, for a particular line item or the transaction item, wherein you pass adjusting entries for all items crossing the performance materiality level, so that therefore you are able to prevent yourself from undetected and uncorrected misstatements crossing the overall materiality level. So, as a part of the objective of the auditor is applying the concept of materiality appropriately in performing the finance when planning and performing the audit. So, overall materiality is to ensure that is considered at a financial statement level. When it comes to materiality for class of transactions, account balances, disclosures, we identify a performance materiality to ensure that we reduce the probability that aggregate of uncorrected and undetected misstatements in that particular class of transaction, account balance and disclosure does not exceed the overall materiality which is determined. So, the overall materiality and the materiality for class of transactions and account balance and disclosure is only relevant if it affects the user's economic decisions as we discussed. Now, how do we use a benchmark to determine materiality at a financial statements level? So we determine the materiality, which uh, is based on our judgment of what are the risks, what are the risks that we have identified in the audit planning stage, as to what are the potential risks of material misstatements. We determine materiality as a matter of professional judgment based on our understanding of the business, understanding of the entity, understanding of the entity concern, understanding what are the complex accounting transactions which are there. As a starting point, a percentage is often applied to a chosen benchmark. For example, we'll discuss about benchmarks in the upcoming slides, which could be profit before tax, which could be assets, net assets, for example. So we apply a percentage to a chosen benchmark depending on the entity concerned. For financial statements which are less or more than 12 months, materiality relates to whole of that period for which the financial statements have been prepared. Examples of benchmark on which a percentage is applied for the purpose of completing the materiality would be profit before tax from continuing operations, total revenue, gross profit and total expenses, total equity or net asset value. These are various examples of benchmark that are used. For specific class of transactions, account balances, disclosures, you may need to identify materiality at a comparatively at a very low level as compared with the overall materiality level. Why do we need to identify what are the factors that that may indicate or that need to set such materiality level for particular classes of transactions, account balance or disclosure? Would be law, regulation or financial reporting framework which affect users' expectations regarding measurement or disclosure of certain items. For example, managerial regulation could be one. For example, there could be disclosure on demonetization that was required as part of the notes on accounts, which was stipulated as part of the Companies Act. There could be disclosures with respect to MSME disclosures, which are required to be made as part of your notes on accounts as MSME Act. So there are certain thresholds which are very low because of the particular stipulation as per the specific law, regulation or the financial reporting framework, which therefore require you to ensure that the materiality for those transactions are kept at a very low level. Certain disclosures which are specific to the industry in which the entity operates, you may adopt a lower materiality level for those particular transactions which are specific to that industry and for which disclosures are required. Focus on a particular aspect of entity's business that is separately disclosed in the financial statements. For example, there could be a small segment which could be relevant to the economic decision of the users of the financial statements, and for which you need to ensure that materiality is kept at a very low level to ensure that that segment is appropriately and properly disclosed as part of your notes to financial statements. What we need to ensure is when we are developing or computing the materiality, we need to ensure that this materiality which is computed is revised as the auditor becomes aware of information during audit that could have caused him to determine a different amount initially. For example, if you have identified certain adjustments which have been carried out, which has resulted in a significant reduction in the profit before tax, you may have to revise your materiality level when the audit is concluded, before the audit is concluded, to ensure that you are appropriately carrying out audit procedures to ensure that your financial statements are free of material misstatement. So there are two stages at which the materiality is determined. One is at the planning stage, wherein you determine the materiality based on the past experience with the company, past experience with the audit that you have conducted. And second is when you are actually carrying out the fieldwork, and if you identify certain additional evidence which indicates that your material misstatement level has to be lowered, you need to appropriately revise your materiality level to ensure that your procedures, the nature, timing, and extent of further audit procedures which you are carrying out for the purpose of the audit activity is appropriate for the purpose of giving a true and fair view opinion on the audit of the financial statements that they are free from material misstatement. So if materiality level requires lowering, we need to ensure that performance materiality is revised. We need to ensure that the procedures, audit procedures that we are carrying out in view of the revised performance materiality is appropriate in view of the materiality threshold that has been revised. Now, what are the disclosures that are required from the perspective of materiality? One is documentation. We need to document that what is the materiality for the financial statements as a whole. What is the materiality level for specific class of transactions, account balance, or disclosures? What is the performance materiality? And any revision to any of the above as the audit progressed is also required to be documented. So even, for example, when you are offsetting items, aggregating items, you need to take care that material items of different nature are not set off or aggregated against each other. So there are various implications of how materiality is looked at when you are making an adjustment entry for any item in the financial statements. Now, what we'll do is we'll understand some concepts on overall materiality. They have some examples which are there. We'll also discuss on certain benchmarks, and then we'll look at how the sector of auditing quality tool is for the purpose of computing materiality for the financial statements. Now, overall materiality, which is, as we discussed, is a calculation of a computation of benchmark percentage, which is applied on the benchmark for the purpose of computing the materiality. What are the common benchmarks which are there? Generally, the common benchmarks which are there is profit before tax of the company, the net assets or equity, total revenues, total assets, total expenses. These are benchmarks which are generally used for determining the overall materiality. What is the general benchmark percentage that is used? Now, there is a range which is there. So, for example, when it comes to profit before tax, the general range which is used is 3% to 8%. Now, when will you use 3% and when will you use 8%? So, when you perceive that the risk of material misstatement is high or increased, then you would have a lower range which will be applied. When you feel that the risk of material misstatement because of the internal control framework which is already there in the company is very low, the range would be higher. So you would therefore adopt a higher materiality threshold because the control framework which is already there in entity concern is reasonably strong. If the control framework is weak, if because you cannot rely on the controls which are there, you would have to carry out more substantive audit procedures for the purpose of ensuring that the risk is reduced to a relatively low level. The benchmark percentage is kept at a low level. So net assets or equity, the general range which is used is between 1% to 3%. Total revenues, then used as a benchmark, the range is 0.5 to 2%. Total assets, again, the range is 0.5 to 2%. Total expenses, the range is generally 0.5 to 2%. So what are the factors which generally influence how the benchmark is identified? The first factor that is there is elements of the financial statements. For example, if I am a user making an economic decision on the basis of financial statements, what is the element which is influencing the most when I'm making an economic decision? So, for example, it could be assets, it could be liabilities, it could be equity, it could be revenue, it could be expenses. Depending on the entity concerned, I would essentially, as an auditor judge, make my professional judgment as to which element of the financial statements would significantly affect my economic decision of with respect to the financial statements of the entity concerned. Whether there are items on which the attention of the users of the particular entity's financial statements tend to be focused. For example, if it's a company which is having a stable, sustainable profit, users may generally tend to focus on profit, revenue, or net assets. So, for example, in a case of a company which is manufacturing entity, which is having a profitable track record, I may possibly focus on profits. For example, in a banking institution, I may possibly focus on the net assets, or a company which is engaged in setting up of plant or you having UCWIP. I may look at total assets of the entity or the total expenditure during the year for the purpose of identifying the material threshold. So I would look at which element of the financial statements is affecting the decision of the users the most, or which item are users focusing most on when they are reviewing the financial statements. So the second factor which affects the benchmark is understanding users as a group. Which area are they focusing on in the financial statements to evaluate whether uh, the financial state for taking their economic decisions. The nature of the entity, where the entity is at its life cycle. What are the industry and economic, what is the industry and economic environment in which the entity operates? So these are areas, factors which you should look at before when you are identifying the benchmark. You should look at and auditors reports of foreign companies, for example, in US and UK, wherein they are required to disclose maturity levels in the audit report itself. You should look at how they are determining the maturity threshold when they are doing the audit of statutory audit of a financial statements of a company concern. They actually go on to disclose the basis for selecting the benchmark, why they have adopted a certain percentage, why they have taken average of the last 3 years, why they have not taken the profits for the current year, how they have revised the planning materiality to the actual materiality when concluding on the true and fair view of the financial statements. So these are reports which you can study to look at what are the factors, how the benchmark has been identified uh, in, in the disclosures which they are making in the audit report in the companies abroad. The entity's ownership structure and the way it is financed. For example, if an entity is financed solely by debt, users may put more emphasis on assets and claims on them rather than on entities' earnings. So you look at whether the company is financed only by debt, financed only by equity. You should look at these aspects when you are identifying the benchmark. What is the relative volatility of the benchmark? Whether there has been in the past 3 years, 4 years, there has been a huge volatility in the profits of the entity, in which case you need to understand how do you moderate that. Whether you would select two or three benchmarks instead of just one benchmark when there's a relative volatility in one particular benchmark. Whether you would alternatively consider another benchmark because the benchmark which you are selecting is highly volatile. So these are factors which you should look at before you identify the benchmark for the purpose of computing the materiality. Now, let us look at some examples of how the benchmark has been applied for various entities. Now, let us look at a profit-seeking entity, an entity wherein there is profitability and there is a prospect for future net cash inflows. One example which may be relevant to assess or to make an economic decision whether to invest in the entity concerned is could be profit before tax. That could be any manufacturing company or a service company. In a case of a listed engagement or a high risk engagement, I would possibly look at a 3 to 5% mortality level for the purpose of for purpose of identifying uh, the mortality level with respect to the benchmark of profit before tax. For non-high risk engagements or a non-listed company, I would look at a range between 3 to 8% depending on my assessment of risk of material misstatement with respect to the entity concerned. Second, let us take, for example, a highly leveraged entity. The entity's ability to service its debt, including the ability to satisfy obligations and comply with debt covenants and continue as a going concern, is relevant because it's a highly leveraged entity. So, if there's significant debt in the company, so the users may look at why the users it may be relevant to understand whether the entity would be able to service its debt in the foreseeable future, whether they would be able to satisfy the obligations with respect to the debt covenants which are there, whether they would be able to continue as a going concern. In which case, I would look at the net assets or the equity of the entity concerned. An industry example for which net is asset or equity would be appropriate for as a benchmark would be airline industry and a telecom industry, wherein there is a history of past losses. And my assessment of engaging with the company as an economic decision would be dependent on how the net assets, what the net assets are, or what is the equity base of the company. If the equity base is very low, there's a risk that the entity may not be able to continue as a going concern. If the equity base is relatively high, my risk is relatively lower. My audit risk is relatively lower because the entity would continue as a going concern in the foreseeable future. So in which case, when it's a listed engagement or a high risk engagement, the materiality threshold would be between 1 to 2%, and a non-high risk engagement or a non-listed company, the benchmark would be anywhere between 1 to 3% of the net assets or equity of the entity concerned. Third example is, let's say it's an entity is in an industry where margins can fluctuate significantly. For example, it could be a startup enterprise or a revenue focused entity. The sales is the base which would drive future profitability and cash flows. So I would look at the total revenues figure because that would predominantly drive the valuation of the entity concerned. So in which case the metric that would be relevant or the benchmark that would be relevant would be the total revenues of the company. Examples would include service industry, AI-based industries, media industry, and again, the range could be anywhere between 0.5 to 1.5% in a listed engagement or a high-risk engagement, and non-high-risk engagement or a non-listed entity, the range could be between 0.5 to 2% of the total revenues. An entity which is coming to the next item, an entity which is primarily generating profit from lending activities, example, a bank or a financial institution or a newly incorporated company, the asset base that drives the lending activity, that is the primary profit generating activities. The asset base would be a relevant benchmark to understand, would be most important for the users of the financial statements. So if it's, for example, if it's a bank or an NBFC, the total asset base of the NBFC or a bank would be a relevant metric for determining the materiality. An industry example could be a new manufacturing company or a cap or something, or an industry which is capital intensive, or a bank or an NBFC. When we look at total assets for determining the materiality level. For a listed engagement or a high risk engagement, the benchmark could, the materiality threshold could be between 0.5 to 1.5%. And a non-high risk engagement or a non-listed company, the benchmark could be anywhere between 0.5 to 2%. The last example which is given here is, let's take an example for an entity which is operating on a cost plus markup basis, which is captive subsidiaries. An entity which is operating on a cost plus markup, let's say I am a fully owned subsidiary only supplying to my only working on a cost plus basis. Profitability essentially depends on what my total expenses are. In this case, the metric that would be therefore relevant is what are my total expenses. And industry examples wherever the cost plus method is being used, the total, those industries could be relevant for the purpose of determining those industries would be examples where this benchmark is used. For example, KPOs or BPOs which operate on a cost plus basis are examples wherein you would look at total expenses as a metric for determining the materiality level. Again, what would be the benchmark? What would be the percentage that would be used for determining the materiality? For example, in listed engagements or high risk engagements, you could use a ratio of 0.5 to 1.5%. Or in a non-high risk engagement or non-listed entity, you could use a ratio of 0.5 to 2% for the purpose of determining the materiality. How do you determine performance materiality? Performance materiality is essentially applying a performance materiality percentage into the overall materiality, which is determined for the financial statements as a whole. Now, what are the, just 1 second, please. Now, coming to what are the factors which should be considered while determining an appropriate haircut for the purpose of determining the performance materiality. So, take for example, you are in the first year of your audit. You would use a lower performance materiality to ensure that any risk of uncorrected or unidentified misstatements is lowered. So essentially, you would use a lower performance materiality if you are in the first year of the audit of the client concern. You have come in as a new auditor. The previous year audit was conducted by another auditor. So since this is the first year of you doing the audit of the entity concern, you would adopt a lower percentage to ensure that that you do not miss out on any undetected or unidentified errors. If the controls are weak, if there are deficiencies which are identified when you are doing a control testing is you would adopt a lower performance materiality. Number and severity of the deficiencies in the control activities, including pervasiveness of internal control deficiencies, is another area where you would have a lower performance materiality. So when you are doing the control testing, if you have identified that there are several deficiencies which have been identified during the control activity, you would therefore adopt a lower performance materiality threshold to ensure that uncorrected misstatements are not missed out. History of misstatements that were accumulated in the audit of financial statements of prior periods. So when you have identified in the past as on experience of your previous audits that there were multiple misstatements which were there, and those misstatements occurred on a regular basis in the prior periods, and therefore to ensure that any misstatement is not missed out, you adopt a lower performance materiality while doing the audit of the financial statements. So if there are history of misstatements in the audit of the financial statements of the prior periods, both corrected and uncorrected, which you have identified during the course of audit, there have been significant adjusting entries that have been passed during in the course of the audit, in which case it would be preferred to adopt a lower performance materiality threshold. Level of turnover of senior management or key financial reporting personnel, if there has been a movement in CFO or the head of accounts, head of finance, there has been a significant movement or churn in the employees, senior management concern, you would adopt a lower performance materiality to ensure that any misstatements are not misstatements which are above the performance materiality threshold are identified and corrected. What is the management's preparedness and willingness to correct misstatements? If the management is more than willing, if the controls are strong, if they are more than willing to correct misstatements, the performance benchmark would be performance maturity would be higher. And if the management is not willing to correct the misstatements, there has been a friction when it comes to preparedness or willingness to correct misstatements. The maturity threshold should be lower. So when you look at what is the percentage of the performance maturity which you generally consider. So if you look at the risk, the aggregation risk, which is aggregation of uncorrected misstatements, aggregation of errors which are identified in the financial statements, which are below the overall maturity level. If the aggregation risk is assessed as normal, the performance maturity is generally defined as 75% of the overall maturity. If the aggregation risk is assessed as increased, the performance maturity is generally considered as 65% of the overall maturity. If the aggregation risk is assessed as high, we generally adopt a performance maturity which is 50% of the overall maturity. Now we'll come to the utility of maturity which is developed by Center of Audit Quality. I will just go through that and then we'll come to certain examples. I'm unable to open the file, Excel file. Yeah, I will give you. Are we able to look at the file? Excel file?
Yes, sir.
Yes. So if you look at this this Excel file which is there, which is being issued, which is there on the website of Center of Audit Quality. I think this is a wonderful slide which Excel file which we should use in computing materiality. So if you look at this file which is there, the guidance is there with respect to how the materiality is guidance is there, which is as per the standard of auditing. There are various concepts which have been explained for the purpose of uh, materiality. What is the need for determining materiality? How should you determine materiality? You should revisit materiality thresholds which are determined by the auditor. You have to determine the overall materiality and the performance materiality. Materiality, what is stated in the audit report. You have to calculate the amount of material misstatements which are there. What are the key definitions which are used? So if you look at the key definition which is there, if you look at the definition of materiality which is there, it says that a threshold above which missing or incorrect information in the financial statements is considered to have an impact on the decision making of the users. And what is performance materiality? The amount or amounts set by the auditor at less than the materiality for the financial statements as a whole to reduce to an appropriately low level the probability that the aggregate of uncorrected and undetected misstatements exceed materiality for the financial statements as a whole. If applicable, performance materiality also refers to the amount or amounts set by the auditor at less than the materiality level or levels for particular classes of transactions, account balances, or disclosures. So this is a very important definition which is relevant and as per the standard of auditing, the definition of performance materiality. So you should ensure that performance materiality is also computed and materiality is also computed for the purpose of complying with the standard of auditing. Coming to the steps which are there. So if you look at again the steps which are there. So the steps involved in determining materiality is specified as assess how you have to assess the risk of material misstatement. You have to choose the appropriate benchmark. You have to determine a level, a percentage of this benchmark, and document the choice with proper justification. The assessment of the risk of material misstatement is identified, the choosing the appropriate benchmark, which we just discussed, the types of entities basis which we can decide on the right benchmark, how do we apply the benchmark based on the entity type, what is the level that we determine using of this benchmark, which is again given as a guidance, specific transactions which require a materiality to be kept at a low level because of the specific legal or regulatory requirement. What are the factors which can be used to determine the percentage which are specified? There's a concept which is given as clearly trivial. What is clearly trivial? Basically, the definition of clearly trivial means that where the items are so small, which are so inconsequential individually or in aggregate and by any criteria, that they would not affect the economic decisions of the users of the financial statements. For example, the guidance states that up to 5% of the materiality is often considered as a clearly trivial benchmark for the purpose of uh, determining for the purpose of materiality specifically for the purpose of materiality standard. So up to 5% of the overall materiality is can be considered as a clearly trivial threshold, which you would not essentially look at. So any error which is less than 5% of the overall materiality, up to 5%, which can be kept at a lower level also, you may ignore those errors and say that those are clearly trivial errors and would not affect the economic decisions of the financial statements. So basically, clearly trivial means that matters which are wholly smaller than that determined in accordance with revised SA 320 and are clearly inconsequential individually or in aggregate and by any criteria. So, which can be set up to 5% of the materiality to be considered as clearly trivial. So, so basically, the disclosures, the documentation which are required to be maintained for the materiality, we need to identify materiality for the financial statements as a whole. We need to identify materiality level for specific class of transactions, account balances, and disclosures because of the specific legal or regulatory requirement which is applicable to those particular class of transactions, account balances, or disclosures. We determine the performance materiality for line items and for specific class of transactions or account balance or disclosures. We include all amounts below which the financial misstatements could be regarded as clearly trivial. All misstatements accumulated during the audit and whether they have been corrected. Basis which the auditor's conclusion as to whether uncorrected misstatements are material, individually or in aggregate, and basis for that conclusion. So after you determine the materiality, so we identify those misstatements which are considered as clearly trivial and hence do not affect the opinion of the audit. I, all other misstatements which are accumulated, whether they have been corrected or not, an auditor's conclusion as to whether these uncorrected misstatements are material individually or in aggregate. We may need to extrapolate the effect of the uncorrected and identified misstatements to the population as a whole if we have identified misstatements from a sample of the population concerned, and the basis for that conclusion on basis the misstatements which have been accumulated during the course of the audit. Now, if you look at this calculation, how do we do this calculation which is there? So we need to perform a risk assessment for the engagement wherein we give a weight. A weight is which is for example, if it's a new engagement, it could be high risk, it could be a medium risk, low risk, or something which is not applicable. And the weightage is given basis the level of risk. For example, if the risk selected is medium risk, I can select between 4 to 7 as a score. If the risk selected is high risk, I can select 8 to 10 as a score for the purpose of that particular risk areas. So these are various risk areas which I've identified. What are the risk areas which could be resulting in a higher risk is whether engagement is new, whether it's a startup entity. There were significant concerns which were identified at the time of client acceptance or continuation. There is doubt on the integrity. The internal audit may not be effective. Ongoing investigations are going on. There's negative publicity which is there on the website of the websites which are there. There's a going concern on liquidity issues. There's been a new IT system which has been installed. There's been a prior history of fraud, error, which is there. Increased risk of override of controls. There are complex accounting, complex arrangements, financing arrangements which have been undertaken. Corporate restructurings or merger or a demerger has happened during the period. Weakness in internal control, insufficient accounting systems, modification in the previous audit report, rapid growth compared to previous year, any other areas which may be considered as significant. So basis this, we identify whether the entity is having a low risk, medium risk, or a high risk. So we identify that as a benchmark basis identification for low, medium, and high. Now, if it's a profit-oriented entity, we take a profit before tax, put in the amount, and if the entity has a high risk of material misstatement, we determine, let's say, a percentage as 6%, and we document the rationale for selecting the percentage, and 6% of the profit before tax is arrived at as the overall materiality. The performance materiality is then determined between 50 to 90%. Here we have taken 78%. 78% of 24 lakh is considered as the performance materiality, and a clearly trivial of 0 to 5%. Here we took a clearly, let's say we take a clearly trivial threshold of 4%, which is 96,000. So anything below 96,000 is considered as a clearly trivial threshold for the purpose uh, of the financial statements in this context concern. There could be specific performance materiality which may be considered for the purpose of account balances or class of transaction, which may be specified here as part of note 3. So if you want to select certain line items which are more critical or which are more relevant for the economic decisions of the financial statements, or because of a particular requirement of the statute, you may have a specific performance materiality lower than the performance materiality which is determined here. In which case you may take a specific performance materiality for specific class of transactions, and you may put that here as part of your working paper. So this working paper really helps you to ensure that you are able to compute the materiality. You have the right documentation which is available. A very wonderful tool which has been developed by the Center of Audit Quality and really helps us in ensuring the right documentation is there. Coming to certain other examples with respect to how you determine materiality. Let's take, for example, this entity, which is it's a listed entity engaged in publishing business, a normal engagement risk. We therefore determine profit before tax from continuing operation as the benchmark. The percentage applied is 7.5% because of the listed status, normal risk, listed entity, and profit before tax is the relevant benchmark for the purpose of uh, for the purpose of the users of the financial statements. Calculation, we determined a calculation of 7.5% of the profit before tax and rounded off the final materiality to 2 crores 50 lakhs. A key learning here, listed entities with normal risk profit before tax is usually the benchmark with percentage between 5 to 10%. Second example, take for example this entity, which is a listed entity likely to be acquired soon, normal controls. Again, the benchmark here is profit before tax for continuing operations. However, the percentage applied is 5 because the risk of acquisition and sensitivity risk is therefore higher. So if there is a risk of business restructuring or a business structure or a merger or a demerger transaction possible, therefore there is a high risk in the applicable to the entity in the current year. Profit before tax is considered as a benchmark, but a lower percentage is applied because of the higher acquisition risk perceived for that entity concerned. So business circumstances may lower the percentage due to higher sensitivity for the users of the financial statements. The third example is, let's take a listed entity, stable growth, strong internal control, low debt. So again, the profit before tax is from continuing operations is considered as a benchmark, but the percentage applied is 10% because controls are strong and there is a history of few misstatements. So the final materiality is considered as, in this case, 8.3 crores, but essentially strong controls and low risk allow you to use a higher percentage for the purpose of identifying the materiality thresholds. Let's take, for example, a listed stable financed internally. The key performance indicator for the employees concerned is net assets. So net assets is industry specific in this case, and the net assets, since the company is engaged in machinery leasing, net assets would be a relevant benchmark for the purpose of assessing, uh, or uh, or would be the benchmark which is relevant for the users of the financial statements. The percentage applied in this case is 2% because the controls are strong and history of few misstatements. So that in a particular industry may, a specific industry, for example, an industry like machinery leasing, the net assets essentially may replace profit before tax because that will be more relevant for the industry concern. A garbage disposal entity, which is listed profits fluctuating, financed through finance through borrowings, and therefore focus is therefore net assets because there's significant fluctuation in profits. In this case, the benchmark is therefore used as net assets and the percentage is 2%. So when profits fluctuate, net asset is considered as a better benchmark for the purpose of computing the materiality. Next entity, a privately owned into forestry business, profits and revenue fluctuate with timber harvesting, significant debt. Again, here the benchmark which is used is net assets. Being a company which is having unstable profits, net assets should be used with cautious percentage selection with respect to understanding of the risk of material misstatement in other risks which are identified in other areas. If the risk is perceived as high, if there is lesser controls, lesser inter controls, the percentage which is applied as 3% will be lower. Clothing retailer, non-listed, stable, minor control issues, but effective overall. Profit before tax for continuing operations is considered since it's a company with stable profits. Smaller private companies, a higher percentage may be acceptable because of low risk otherwise. Again, an antiquities dealer company which is privately owned, stable revenue and profit, inventory is significant. Multiple, which has been considered as multiple benchmarks have been considered, which is profit before tax, revenue, and net assets, and an average of the three has been considered to ensure that a balanced figure is arrived at. There are multiple figures which affect which are monitored or factored in by the users of the financial statements. And since it's a company which is having a significant inventory and profits only on the bench a materiality threshold only on the basis of the profit may not be the right figure. You may need to look at three figures to arrive at a more balanced computation of the materiality. A wholly owned subsidiary financed by parent, strong controls, low risk. So the company does not have any debt. It's a wholly owned subsidiary which is completely financed by parent, and the strong controls which are there, and therefore they're low risk. There's a low risk. Profit before tax from continuing operations is therefore the right benchmark. A percentage which is applied is very high, which is because the risk is perceived as low and completely backed by parent. So the liquidity or the going concern risk is not there. And the percentage, therefore, since there is significant support from the parent entity, the risk which is used is low because of the and allows risk is low, and therefore it allows use of a higher percentage of final materiality. Again, modification of the last example, a wholly owned subsidiary financed by parent, strong controls, low risk but has external debt not backed by parent. In which case, I have adopted a lower percentage of PBT, which is 7.5%, because there is a debt risk in the company, which is not supported by parent. A presence of external financing reduces the percentage applied for the purpose of determining the materiality. So, example 9 and 10, similar examples, but the threshold is reduced. The materiality percentage which is applied to the benchmark is reduced because of the risk of external financing in the entity concerned. A company which has a long production cycles, profit fluctuates because few large products, long cycle, maybe infrastructure, real estate company. We use the benchmark profit before tax, but normalized over a period of 5 years. So we look at average PBT for 5 years and have and apply the materiality percentage or the overall materiality percentage to the benchmark on the average profit before tax for the last 5 years. We round off to 3 lakh. So when profits are significantly varying and the decisions of the users would depend on the profits of the entity, we use a multi-year average for the purpose of determining the materiality. Profit for the year during the year includes rupees 50 lakhs as damages, which is extraordinary item. So the profit before tax for the benchmark which is used, we should normalize that by excluding the damages which are received or paid by the entity concerned. So the adjusted profit before tax should be considered for the purpose of determining the final materiality. And essentially, we are required to therefore exclude one-off or extraordinary items from the benchmark to arrive at the fair materiality level for the purpose of doing the audit of the financial statements. A telecom entity which is partly owned by the state, a listed entity which is 49% state owned. Media, there's a focus of the public on management remuneration disclosure. Audit committee has also shown a lot of interest in what is the management remuneration. So profit before tax is considered as 98,30,000, which is 7.5%, which is overall financial statement materiality. But the specific materiality for the remuneration disclosure is considered as only 50% of the finance materiality. So it should be 5% of the 98,30,000, and therefore 5 lakh is considered as the purpose of for the purpose of specific materiality for a entity for the purpose of remuneration disclosure. So in sensitive public interest entities, the materiality must reflect the state stakeholder expectation. How do you determine performance materiality? 2-3 examples there. Let us take that materiality has been set as 50 lakhs. Client is there for 5 years, stable business, no major risk or control changes. Past uncorrected misstatements have been around 20 to 30% of materiality. Last year, uncorrected misstatements was around 10 lakhs 34,000. So since there have been consistent misstatements which are not trivial, we need to buffer in some we need to buffer to ensure aggregate misstatements do not exceed the materiality, and therefore performance materiality is set as lower, which is 70% for caution. In this case, materiality set as 50 lakhs, prior uncorrected misstatements was 12.5 lakhs. No significant changes in risk or control, but partly new management. New management is committed to correcting all the misstatements unless trivial. History of misstatements, but fresh management attitude risks reduces risk of carryover. Auditor can allow therefore a higher percentage than the previous year. And therefore performance maturity is set as 90% because the management is showing a corrective intent and risk is stable. Performance maturity can therefore be set as 90%. Third example, a company which is a wine and food importer, maturity set as 9 lakhs. Client for 2 years, no major changes. Prior uncorrected misstatements is almost 4 lakh 21, which is 47% of the maturity set. Rupees 1 lakh 71 has been reversed in the current year. Misstatements significant compared to maturity. Risk of recurrence not low. And therefore, large recurring misstatements, we need to set the performance maturity conservatively. I think this is all with respect to the standard on motility and some examples which we have discussed. Any questions? I think we can take now.
Yes, sir. First of all, thank you, sir, for sharing the valuable insights on SA 300 and SA 320. In today's session, we have joined by more than 800 members, and we have received some questions from members. So I request you to please take these questions. Sir, the first question is related to planning. The question is that in the previous year, the audit report was qualified due to limitation of scope. So, what specific planning considerations should be made in this current year audit?
So I think if there has been a qualification with respect to the previous year, and if we are the new auditors, we should first discuss with communicate with the previous auditor. Of course, that is a requirement. We should also discuss with the management on why the scope limitation existed. What are the documents which were not supplied, or what were the explanation or information which were not supplied to the previous auditor, which could therefore affect our planning of the audit of the financial statements in the current year. Whether the management is now agreeable to share such information, because that scope limitation may not be there in the should not be there in the current year. Whether the intent of the management or the integrity of the management is right to share such information or share such explanation or documents which were not supplied by the auditor by the management to the auditor in the last year. I think these are aspects which we should look at.
So the next question is the if the engagement partner changes during the mid audit, what aspects of planning must be revisited and redocumented if the engagement partner change during the audit?
So engagement partner, if I think it's more of how the firm's qualities control policies are there within the firm itself on a change of the engagement partner. Because the engagement partner, if there's a change within the same firm, there should be a process of handover from the previous engagement partner to the new engagement partner. The new engagement partner should look at what are the reasons for the engagement partner not being able to carry out the activity. If he's a continuing partner in the firm, the risk could be higher for the new engagement partner who's taking up the responsibility. But if the partner has left for some reasons, because of career growth or any other reason within the firm, there should be a process of handover from the earlier engagement partner to the new engagement partner of the planning document which has been carried out by the earlier engagement. That's all for. You're muted, sir. Vivek, you're muted.
Sorry. Sir, how should the auditor apply materiality in the case of a non-profit entity where profit is not the main indicator for that entity?
So we discussed a lot of examples where net assets could be a basis, where total assets could be a basis, total revenues could be a basis, total expenses. It really depends on the nature of industry and which metric affects the economic decisions of the users of the financial statements most.
So the next question, the auditor determines overall materiality at 5% of the profit before tax. Midway through the audit, significant losses arise due to an unforeseen events. Changing PBT from profit to loss, how should materiality be revised?
So I think then we should look at whether the metric that we have chosen was the right metric. We should evaluate whether we should have adopted an alternative metric. And if there has been a loss due to an extraordinary circumstance or an exceptional circumstance, we should normalize the profits for the current year to determine the appropriate materiality threshold.
And so the next question is, if the auditor set performance materiality at 75% of overall materiality, but multiple small misstatements are found across different accounts, then how should the auditor reassess in that case?
So if multiple small misstatements are identified which are clearly trivial, we should ignore them. We should just make a note of that. These are clearly trivial and therefore does not affect my audit opinion. For items which are not material, we should accumulate those errors and identify whether they would in aggregate exceed the performance materiality of the financial statements.
And sir, the next question is related to Excel utility. Like once materiality has been determined as per Excel utility, can we still use our judgment to by pass on case-to-case basis?
No, so you can, of course. So again, I think audit is a matter of professional judgment by the auditor concerned. It should be based on sound principles. They should be documented. So Excel sheet is again a basis your judgment of the risks which you assess. The percentage is again which you have to input based on your judgment, and that percentage has to be again determined based on a sound rational principle which another auditor, if he would look at, or another person would not refer to it as something as a judgment which is completely wrong. So it is something which has to be evaluated based on the specific facts, and the judgment should be rational, which should be documented.
And the last question, sir, that we have received now, right now, we need to calculate materiality entity wise or line item wise, like.
No, so first, so the objective of determining the materiality is to determine the materiality from an overall financial statements perspective. Performance materiality is determined basis. The objective of determining the performance materiality is to ensure that you determine performance materiality for line items essentially. So the performance materiality which you take as 60, 70, 80 or 90% of the overall materiality is to ensure that any line item which exceeds that performance materiality is specifically evaluated and examined in greater detail. And you carry out audit procedures in response to the perceived materiality of those line items which exceed the performance materiality level.
Thank you, sir. Thank you, sir, for sharing your valuable insights and taking all the questions that we have received from participants. And I also thank you all the participants for their active participation. And thank you, sir. And
Thank you. Thank you, Vivek. Thank you for